Geopolitical risks are a big concern. We have somehow managed the situation so far, and we're not seeing big spillovers from the Middle East, but that is not a given. And that's one of the big risks that we do see. The implications that could have for oil prices could be substantial if the conflict were to escalate and become a much bigger conflict. We're not there yet, but that is an important risk. And the other risk, of course, is that we're in an environment where trade is not what it used to be. There is a lot of tension across trading partners. There's a move towards protectionism. There are concerns about national security and economic security. And all of that typically raises the prices of goods around the world. And that, again, is a force that moves against bringing inflation down.
What would an oil shock do at this point in the cycle where growth is just not as strong as it was previously?
It would have differential impacts on different parts of the world. The US economy is strong for other reasons, and it's also now an economy that is much more insulated from oil shock developments in other parts of the world, energy price developments in the other parts of the world, given it's a major exporter. The shale exports that it has, it plays a very important role. But there are other parts of the world, I would say Europe is particularly susceptible to what could happen if energy prices were to go back up again. And there they have a biggest trade-off, which is, they have to bring inflation down, and the economy is also weaker than the US economy is.
Geopolitical risk combined with strong US data has fueled the greenback strength, and even in the last 24 hours or so we've seen intervention by the Indonesians to stem some of the weakness in the rupiah. South Korea, they've issued a statement, watching the won. Malaysia, India, all on high alert too. What do you make of the volatility we're now seeing in FX?
Some of that volatility is to be expected. We have a situation where US rates are expected to be higher, at least for somewhat longer. That makes the differential between US interest rates and the rest of the world's interest rates much bigger, and therefore, that's going to put pressure on their currency. So we are seeing a strong dollar phenomenon again. We saw something like that towards the end of 2022, in the second half of 2022. We are seeing signs again of a strong dollar, but it is to an important extent driven by the fact that interest rates are expected to be higher for somewhat longer in the US.
You and I are talking later in the week about capital flows and some of the risks ahead. As we talk about policy divergence, what is the risk of more volatility coming back into capital flows that have just been restored to a lot of emerging and developing economies?
Yeah, what is true is that financial conditions eased quite a bit in the start of this year. If the recent take on what's happening with inflation, if that means that the US is going to move much more slowly, that could end up with some tightening in financial conditions. But that said, what I do want to point out is the last 3 to 4 years, emerging and developing countries have actually shown greater resilience than most of us were concerned about. They've had good macro frameworks in place that they've used to insulate their economies. And so, I think, yes, it is a downside risk, but I don't think necessarily is going to lead to bad outcomes in terms of capital flows or in terms of general volatility.